A pleasant day to everyone. Welcome to an online activity presentation. My name is Matin Montri, and on behalf of my groupmates, we will be presenting a presentation on risk management. So, for the agenda today, me and my groupmates will be talking about reputation risk, market risk, credit risk, liquidity risk, and also legal risk.
To begin, reputation risk refers to anything that has the potential to damage a company's public perception, or in other words, their reputation. Positive reputations help to attract more people, such as investors and customers. Furthermore, the market also believes that such companies will deliver sustained earnings and future growth. Moreover, in an economy where 70% to 80% of market value comes from hard-to-assess intangible assets such as brand equity and goodwill, companies become vulnerable to anything that damages their reputations. This type of risk can be found in the case study where the bank had created up to 2 million unauthorized customer accounts to meet sales targets and resulted in the bank having to pay $185 million to government officials over a sales fraud investigation. This would have greatly damaged their reputation, making the bank less trustworthy for potential customers, potential investors, and current stakeholders, as they were involved in fraudulent activities. After identifying the risk, we need to know how to reduce or prevent these issues as the chief risk consultant, according to question 2. Beginning with how to reduce the impact caused by these risks, the bank should quickly respond to the scandal to salvage any remaining reputation left by sincerely apologizing to the involved parties and the public after the issue. The bank could also impose punishments to those that were involved in the issue as a way to regain trust from the stakeholders and the public. On the other hand, to prevent the impacts from such risks, the bank should set more objective and realistic goals in the future after carefully assessing their business operations, so that employees wouldn't resort to extreme measures just to meet goals. The bank could also provide more training to employees with an emphasis on ethics, and make them understand that any action could end up damaging the company's reputation. They can also introduce a code of conduct and set up certain policies and procedures to remind employees to conduct their work ethically. That's it for reputation risk. Next up, Zenhan will talk about market risk.
Market risk cannot be eliminated through diversification. Market risk may arise due to changes to interest rates, exchange rates, geopolitical events, or recession. The standard deviation of changes in the prices of stocks, currencies, or commodities is referred to as price volatility. The treasurer can practice the risk management processes such as identify the risk, analyze the risk, prioritize the risk, treat the risk, and monitor the risk. Even though it can't entirely avoid the risk, it can anticipate and mitigate the risk through an established risk management process. To manage the bank risk effectively, the board of directors and management can build and reinforce the bank risk culture, articulate and monitor adherence to the risk appetite, and establish the bank risk management architecture with 3 lines of defense to identity, measure, monitor, and control risk. The processes such as identify risk, assess and measure risk, monitor risk, and control risk. Identify risk. Risk identification is a continual process and occurs the transaction portfolio and enterprise levels. The bank shall identify interdependencies and correlations across portfolios and lines of business that may amplify risk exposure. Assess and measure risk. Accurate and timely measurement of risk is essential to effective risk management. The bank needs sophisticated measurement system as to the complexity of the risk increases. Monitor risk. The bank monitors risk level to ensure timely review of risk position and exceptions. Control risk. It controls exposure to the various risks associated with the bank activities. So now I will pass to Shona.
Thank you, Zhen Han. Now I am going to talk about the third risk that identified from the case, which is credit risk. Credit risk is defined as the possibility that a bank borrower will fail to meet its obligation in accordance with agreed terms. The source of credit risk from the case are financial difficulties caused by the penalties and the strings of bad news. From the case, Deutsche Bank is facing numerous penalties. They have to pay a 40 billion fine over mis-selling mortgage-backed securities, 185 million settlement with government officials, and 20 million for violation of the Service Member Civil Relief Act. This will lead Deutsche Bank into financial difficulties and indicate a low ability to repay their existing credits, especially to their bondholder and loan. Moreover, considering the situation of the bank and big issue it facing during that time, most of its investments have a higher possibility of deteriorate in quality or going into default. The confidence of investors and shareholders in Deutsche Bank are rated and low, which will make them pull out their funds from the bank or avoid investing in the bank. This will cause Deutsche Bank hard to have sufficient funds to do their payment in time, risk of payment being delayed or even worse, default. Therefore, there is a credit risk that Deutsche Bank has no capacity to repay its existing credits according to the agreed term, which may be caused by the possibility of financial difficulties that they face due to the penalties and the bad news. Next, if I am a risk manager, I will advise the bank to use asset and liability management to address credit risk, which is caused by the financial difficulties. Asset and liability management is a process of managing the use of asset and cash flow to reduce the firm's risk of loss from not paying a liability. The concept of asset liability management focuses on the timing of cash flow because company managers must plan for the payment of liabilities. The process must ensure that assets are available to pay debt as they come due, and that asset earning can be converted into cash. Now, I am passing the speech to the next speaker, Jay Wing, to talk about the next risk we identify from the case.
Thank you, Shauna. So now I'll be talking about liquidity risk. So liquidity is the ability of a firm, company, or even an individual to pay its debts without suffering catastrophic losses. Conversely, liquidity risk stems from the lack of marketability of an investment that can't be bought or sold quickly enough to prevent or minimize a loss. This type of risk arises when an entity starts to encounter difficulty in realizing assets or otherwise raising funds to meet financial commitments. As seen in this case, the bank has been under the hammer since receiving a $14 billion fine for mortgage-backed securities from the US Justice Department. As they must pay a large sum of money, there is a great chance that the company will be in a position where they will not be able to meet their liquid fund requirements. Now, the advice to mitigate liquidity risk is to have a conscious financial planning and analysis. This can be done by forecasting cash flow regularly while monitoring and optimizing net working capital. By doing so, the organization will have a better understanding of its liquidity and will be able to identify the risk earlier and prepare themselves for it. In addition, the organization should also develop effective contingency plans in order to have more strategies on managing liquidity risk. The organization should have a formal contingency funding plan that clearly sets out the strategies for addressing liquidity shortfalls in emergency situations. Next, I will pass to Martin to talk about the legal risk.
So, for the last risk, we have the legal risk. The definition of a legal risk refers to the possibility of suffering a loss as a result of an inadvertent or negligent failure to fulfill a legal duty to a particular client. Legal risk can also occur as a result of features and construction of the product. The legal risk becomes more complex when it involves international financial operations. This is due to the fact that foreign law applies to many aspects of the organization's transaction. Legal risks can be found in case studies are because of alleged violations of the Service Members Civil Relief Act. As was the case in this instance, the Wells Fargo Bank might be subject to even greater penalties, including a fine up to 20 million. The Injustice Department is preparing to penalize the bank for seizing military personnel's personal vehicles. In this slide, the main causes of legal risk are shown. So the main causes of a legal risk are contracts, litigations, regulations, and structural changes. So what ways can the bank prevent legal risk? Firstly, stop all activities that lead to legal risk, which means discontinue any activities that may cause the bank to suffer a legal risk. And secondly, identify the possibilities of the legal risk and find solutions to overcome it. And thus, we have reached the conclusion of our presentation. Again, my name is Matin Montri, and on behalf of my groupmates, we say thank you for watching.